Hi everyone, good evening and welcome to Moneycontrol. I'm Karunya Rao, and in this special live, we're here to slice and dice the Q4 GDP numbers and, of course, for the entire fiscal FY22 as well. Latha Venkatesh joins us to help us understand what these numbers mean, what it reflects about the state of the economy, and how the street is likely to react as well. Latha, thank you so much for taking time out and talking to us today. So the headline number, GDP, gross domestic product, has grown by 8.7% for FY22 and 4.1% in Q4 of FY22. Of course, the growth that we're looking at is because of low base effect. But overall, how has the performance been, and is the street going to like it?
Well, the growth has been actually in line with expectation. The NSO, the National Statistical Organization, in its second revised estimate, had expected an 8.9% growth. It has come at 8.7%, but that won't shock the street much because the CNBC TV18 poll was also 8.7%. For the fourth quarter, the CNBC TV18 poll was 4.1%. So don't expect any reaction of the GDP number. It's exactly in line with expectation. Actually, all guns have fired, but that was because all the guns were silent last year, except agriculture. Very good growth, over a 3.3% growth in FY21. It's a 3% growth in FY22. Very good because rural consumption should hold up. Likewise, manufacturing has come in 10% higher, 9.9 that is. But that was because it was zero in FY21, which was the big COVID year. The one number that I would worry about is is a big item, what you call trade, hotels, transport and communication and broadcasting. That is the services. Trade and hotels, small Udupi hotels and ST bus transport would come in that. That's the one that has grown by 11.5%, 11.1%. But that's because last year it was minus 20%. So, they have not even made up for the hurt of last year, which would be a point of bother. It's not a surprise, but it is certainly an unhappy lack of growth in that sector, and one hopes that that would recover. And finally, government consumption has helped a lot, or government spending, government sectors, public administration, defense, and other personal services. That's grown by 12.6 compared to minus 5.5 last year. So even accounting for that minus 5.5, there is a good growth of over 7% in the current year. So basically, many sectors have fired in terms of GDP. We will have to look at it from the consumptions area as well, but from the output area, there are no shocks.
But how is the consumption figures and what does it tell us?
Well, consumption is good if you looked at the full year, 7.9% higher. Now, again, I want to caution you that when I say it is very good at 7.9%, it has made up all the losses of FY21. If you look at the overall consumption figure for the full year, then it's exactly as it was 2 years ago. The overall personal final consumption expenditure is 83.7 lakh crore. 2 years ago, it was 82.6 lakh crore. So, compared to the pre-COVID year, it has grown by just about 2%. But compared to last year, which was terrible, there is good 7.9%. Likewise, gross fixed capital formation. What you look at is basically consumption and investment. Investment is gross fixed capital formation. That's come in at a good 15.8% growth over last year. Again, last year was a terrible year. If you compare it to 2 years ago, then, well, the growth is a little modest at about 2%. I would, however, want to point out that gross fixed capital formation is very good in the fourth quarter. The fourth quarter gross fixed capital formation is come at 5.2%, which is good because, we lost half the quarter to Omicron. And the last part of March was also affected by container disruption, etc., because of the Ukraine war. In spite of it, if investment has done 5.2, that I think is a positive surprise from the GDP numbers.
But you said all guns were, firing. We have a low base effect at play as well. But how are the near-term prospects looking now? Because still, inflation continues to be a big worry. Commodity costs are, going through the roof. There's still no certainty about Russia, Ukraine, and how the whole conflict would play out. Interest rates are going to rise. RBI is not going to be any different. So what is it? What are the signs that you're picking up, and what is it that economists are flagging off now, in the next few quarters? How are things likely to be?
Karuna, you summarize the problems and the headwinds excellently. The year is, still very young. We are only 1.5 months into the year, or maximum maybe 2 months into the year. We have more than 85% of the year in front of us, and the signs are not looking very good. The RBI is standing at 7.2. It will probably lower it marginally to maybe 7%. We don't know, given that crude is very high, and that takes away from consumption a bit. But the real hurt may come only the year after, as RBI starts hiking rates. The impact of that will be seen in the coming FY23-24, when perhaps growth could fall to 6%. That is the big worry. Almost everyone in the street is standing at 6% or lower for FY24. For FY23, estimates are all over the place. We have people like CRISIL and Deutsche Bank expecting that growth will be even better than what RBI has forecasted, 7.3 and 7.5. Again, the base will help, because FY22 is not a great number. It is just as good as FY20 2 years ago. It is only about 1.5% higher than 2 years ago number. So because of this weak base, we may see FY23 also doing reasonably well at 7%, 7.3% is what CRISIL and Deutsche Bank are arguing. But Soumyakant Ghosh of SBI, and more importantly, Rupa Rege-Vetsure, the economist from L&T Finance, an important person. She was part of the Urjit Patel Committee on Inflation Targeting. Both these economists are expecting that the growth in the current year could be 6% to 6.7%. Rupa is very pessimistic at 6.2%. Soumyakant Ghosh at 6.7%. But look at the range. Rupa Rege at 6.2 and CRISIL and Deutsche Bank at 7.5. It's a big difference, because everyone is unable to forecast crude. There are a lot of people who believe that crude will fall to double digits in the second part of the year, because there will be recessionary conditions in the US after all the tightening, and maybe in Europe because of the war and the tightening. And there are others who believe that crude may still fire because of supply constraints, even if demand is weak. So if crude remains at 105 average for the year or 110 average for the year, then the prospects of the economy moving towards below 7% is very high. But if crude comes down, then our luck can be improved.
In fact, this unpredictability was also flagged off repeatedly by our government and the RBI as well. So crude, and which way crude actually finally sits, is something that everybody is trying to figure out. Let's see how that plays out. But talk to us about the fiscal deficit number as well. Slightly lower than estimates, slightly lower than the target of 6.9%, coming in at 6.7%. Should we see it as a good news, or is there some other factors at play?
Well, first of all, the number is lower because the numerator is larger. We have had an extraordinary inflation last year. So if you look at nominal GDP, the GDP that we talk about, this 8.7, that is what you call real GDP. You've taken all the goods and services at current prices and deflated it to 2011-12 prices to get the real growth in volume. But if you just took it at face value at current prices, then GDP has grown by 19.5%. That was not the original expectation. The budget revised estimates had expected it to grow by 18.5 to 19%. So because the nominal GDP is higher, the fiscal deficit is lower. But the fiscal deficit is also in aggregate a little lower. It's lower by about 5,000 crore, because today we got the full year fiscal numbers. That perhaps is a little bit of a positive 6.7, but a lot of economists on the street expected it to be a lot lower, because they expected tax collections to be good. Now, tax collections are good. They are 2 lakh crore more than what the revised estimates said in the budget. The budget said the total tax collection by the center would be 25.16 lakh crore. It's come at 27.08 lakh crore. So almost 2 lakh crore more. That should have brought the fiscal deficit lower. But no, the government has transferred a lot more to the states, which is very good. It has transferred about 1.4 trillion more than expected. And that is why the overall numbers of the central government are not looking very different from the budget estimates. The basic takeaway from that is that tax collections are very good. And because the tax collection base has moved up to 27 lakh crore, the current year tax collection will also be higher. Because the base is higher, if it grows at the the budget estimates of whatever 10 to 12%, then you are going to get a better tax collection this year also. So on the fisc, actually the news is good, but again I want to caution you, it's not as good as the market expected. This 2 lakh crore excess was expected, and therefore I don't think tomorrow the bond market or any other market reacts very positively.
Okay, let's see how that plays out. But thank you so much for slicing and dicing the numbers for us, and to dig into the nuances of the GDP numbers. Thank you so much, guys, for tuning in as well. We'll see how the markets, equity, bond, and everything else reacts tomorrow. But for now, that's all from us. Thank you for tuning in.